India. It's one of the best places in the world to invest in. This is Investination India. It's your chance to learn why investing in India is a home run. You'll get actionable tips on how to invest, ways to invest, where you can invest, public and private markets, venture capital, private equity, angel investment, startups, and technology. There's a lot to cover, so let's do this. This is Investination India, and this is your host, Manish.
Prem, welcome to the first podcast of Investination India. Why don't we start with giving an introduction about you, who have been a prolific investor for so many decades? Then we'll dive in.
Thank you, Manish, for having me. In some ways, I think the story that I want to lay before you is one of change and transition and growth. And that's what I've invested in over the last 30 years across the emerging markets. Every now and again, you find these windows of opportunity where you find countries on the cusp. And that, to me, has always been the window that provides this most significant opportunity for change, for growth, for investments on a 5 to 10 year view. And that's where significant delta is created for potential investors that have the courage to look into the future and to be patient and wait for stories to evolve. I started out investing in the emerging markets for the Capital Group of companies in 1992. And so for the past 30 years, that's really been my mandate and remit, investing on behalf of our clients' portfolios across Asia specifically, but also with a very clear intent and focus on identifying opportunities for change and for growth. I retired from the Capital Group in 2014, and we launched the Tantallon India Fund in September of 2015. And since then, what we've tried to do is to focus in on idiosyncratic growth opportunities that take advantage of India's transitioning in a very intentional manner to structural reforms and allowing entrepreneurial risk capital in India and overseas to identify opportunities where India can differentiate itself on a very sustained basis. That's the opportunity I'm most excited about, and that's the opportunity I want to make sure I spend the time laying out for you.
So Prem, tell me, because you have seen India really evolve past almost 30 years, and the biggest concern investors have always had with India is that it walks 2 steps forward and 1 step backward. So do you think there has been some significant change from that story now, or India continues to remain the same?
I think India is different. India is different from times past, and it is different singularly because of the parliamentary majority that this particular government has enjoyed for the last 9 or 10 years. As India was transitioning into a market-driven economy, it had always been forced to deal with the compulsions of coalition politics, to the extent that you have a single party today that sets the agenda and drives a reform-driven framework that encourages investments and opportunities in India. It makes a very clear statement of intent. India is different from times past. It's not to suggest that all reforms progress in a smooth, level manner, or that all reforms are naturally predictable, because reforms are often held hostage by elements beyond the control of any one particular government entity. So, for example, the war in Ukraine is not something that we could have imagined even a year ago. And it introduces challenges in a reform-driven process when India is a net importer of energy. And so it does demand reforms, but reforms that are flexible enough to adjust to and reflect evolving geopolitical constraints, evolving macro issues, evolving trade flows, evolving compulsions between superpowers and aspiring superpowers. And so the reform process, while consistent and stable, has to be flexible enough to adjust. And I think that's truly what we have seen. So my contention to date is that the reform process in India is durable, is consistent, is very intentional. There will absolutely be points in time when geopolitical events or global macro events force the reform process to slow down relative to expectations. But I do not doubt, like I've doubted in the past, the intent of the reform process and the ultimate trajectory of the reform process.
That's interesting to know because you mentioned that you initially used to doubt the intent of this reform process. Is it only because of the parliamentary majority that you see that thing changing, or there is something else?
Well, there's no question, right? I mean, as I mentioned before, the parliamentary majority is something that is unique to India in the current environment. It is not something that we've taken for granted in the past. And it's certainly something we've always worried about because the compulsions of coalition politics invariably had forced reform measures to be diluted. That I don't worry about anymore. That's the significant change that we've seen with India in the last really 8 or 9 years, where that reform process has been facilitated by the parliamentary majority. I think there's a very clear message coming out of Delhi today is that India has an opportunity to carve for itself an industrial economy that provides employment on a sustainable basis to 20 million young people turning 20 every year. That's the big challenge for the Indian government today. That's the driver of their reform process and the initiatives they have articulated across a multiplicity of sectors. They absolutely need industrialization to be institutionalized in India and to create that groundswell for employment opportunities to employ the young people such that you're looking at harvesting a demographic dividend as opposed to worrying about demographic time bombs.
How do reforms translate into financial gains for the investors? These are reforms which are very long term. What I know is that a lot of FIIs, they have started pulling out, or they have pulled out a whole lot of money out of India. What do you have to say about it?
I think there are two pieces that I think you need to internalize. One is the fact that true long-term risk capital always has to be domestic, because as you pointed out, it is not then subjected to the vagaries of the financial capital markets or to capital flows or to rising risk aversion because of some global macro event or some global geopolitical event. So to the extent you can tap into domestic risk capital, that's your sustainable source of growth capital that every country, every growth economy aspires to. And my point to you would be that given the sustainability and the predictability of the reform process, for the first time in 30 years, domestic risk capital is aggressively looking for long-term investment opportunities to facilitate India's growth story. That's what's really such a powerful driver of sustained growth momentum that the markets truly have yet to truly understand and appreciate. The second part, and I think it's just as important as you evaluate volatility of flows. Foreigners will come in and foreigners will go out based upon their assessment of global risk appetite and global risk allocation. However, what is clear increasingly to all of us today is that in an environment of challenged macro growth, as global central banks look to tighten intentionally to combat the issues of inflation that are so visible to all of us, India is going to be one of the few markets, despite tightening capital, that will actually deliver on strong nominal and real GDP growth. So my expectation today is that India is in a place that it will deliver on 6 to 7% sustained real GDP growth over the next 3 to 4 years compounded. That translates to nominal GDP growth in the 11 to 12% range over the next 3 to 4 years compounded. And that provides an amazing backdrop for equity investment strategies. And I think as a result of that, you are simply going to see increased risk capital globally being assigned to India because of the visibility that India would provide on real and nominal GDP growth.
can we just throw some numbers, or do we have some kind of a comparison where India stands, and has US also gone through a similar kind of a phase in its growth cycle? Sometimes India also gets compared with China in that regard.
Yeah, I don't think the comparison with the United States is a good one, because for that comparison to actually be meaningful, you would probably have to go back into the 50s. So after the Second World War, as the US was industrializing its economy. I think the more relevant comparison for us in emerging markets is really what we saw happen first in China and then with the Asian tigers, where you had significant changes to global trade agreements and World Trade Organization agreements that facilitated the development of an industrial economy and an outsourcing economy in China first and then in the rest of the ASEAN. I think that's the comparison that's most relevant for India. And as we've learned quite painfully over the course of the last 4 years, going through first the Trump tariffs on China, then the COVID dislocations, and most recently, the dislocations because of shortages in labor in terms of the global supply chains, is that there is a compelling narrative being built around diversifying global supply chain dependence on China. And as you focus on that opportunity, India, thanks to its low-cost engineering talent and its large pool of relatively well-trained labor, you have an opportunity to take incremental market share as global supply chains get relocated to different parts of the world. India is in pole position in many ways, thanks to the structural reforms that have been put in place, incentivizing risk capital being allocated to the industrial economy in order to create jobs. So in some ways, it's a perfect confluence where the domestic imperative to create jobs dovetails so neatly with a global imperative to find another large-scale manufacturing destination that global supply chains can depend on or build a business model around. And so that's the opportunity for India, quite frankly, as you evaluate the opportunity for the next 3 to 5 years. It starts clearly with the structural reforms being put in place by the current government, thanks to their parliamentary majority. It focuses very clearly on India's demographic growth dividend and the opportunities created by industrialization, the opportunity to replace China incrementally in global supply chains. It very clearly focuses on domestic risk capital being invested to facilitate not just employment opportunities, but truly industrial opportunities on a large scale, and ultimately feeding into a domestic consumption economy as domestic real wages rise, creating a groundswell of momentum for domestic consumption.
I believe that China holds such a large share of global supply chain in terms of manufacturing. Do you think that, let's talk about some numbers. What do you think that India can really support in terms of those numbers?
Well, it's impossible to put a number, right? Because, your guess today is as good as mine. You're on the cusp of a transition in the global economies. You're on the cusp of a transition in terms of global supply chains and their willingness and their ability and their commitment to continue to diversify away from their dependence on China. And it's not just India that will benefit. So will Vietnam, so will Indonesia, so will Mexico. But India, again, because of its large domestic population pool, its low-cost engineering talent, and the willingness of domestic risk capital to facilitate industrialization and investments in manufacturing, is in pole position to benefit from the dislocations to the global supply chains that we've seen. My sense, and this is truly, a sense because it's simply too soon to put numbers to it, is that India will see $60 to $70 billion of foreign direct investments into domestic manufacturing over each of the next 2 to 3 years. It's a small number relative to the billions of dollars that have gone into China over the course of the last 25 years since China joined the WTO. But it's a start. And I believe that once you establish proof of concept, once global supply chains realize that they can depend on India, not just in terms of quality, but also reliability of supply, you will see a cascading impact of investment decisions being made by boards globally. where corporate entities will intentionally focus on diversifying their supply chains into India for the reasons that I've articulated before. So I believe that the $60 to $70 billion over each of the next 2 years has the opportunity to go up 5 or 6-fold over the next 5 years. And that's the opportunity, I think, that's still underappreciated by the markets.
So, from a perspective of domestic risk capital, I think there is a very small amount of domestic risk capital which goes into markets as compared to what is there in US.
I think it's really important to distinguish the comment that you made. You said go into the market. Domestic risk capital is going into manufacturing directly. The fact that you have a large entity like Reliance Industries deploying its profits from refining into retail, into telecom, that's domestic risk capital being put to work in domestic India. To the extent that you have significant resources being invested to develop India's logistics and warehouse infrastructure, that's domestic risk capital being applied. It's not necessarily going into the stock market. It's going to create actual manufacturing entities and actual industrial infrastructure that then facilitates the long-term investment opportunity and facilitates the long-term job creation. And I think it's really important to distinguish, because domestic risk capital going into equities versus domestic risk capital actually consistently being allocated to job creation and industrialization and the infrastructure required to facilitate consistent growth. And that's the part that I'm most comfortable with and excited about. Money will come in and go out of the equity markets. Money will chase returns. But my underlying premise to you is that without the allocation of domestic risk capital to enabling infrastructure, to industrialization, to manufacturing domestically, and to domestic job creation, all the rest will not materialize. So you have to start with this. And that's what I'm most excited about, because that's what I'm seeing corporate India do for the first time in 30 years, very intentionally allocating its risk capital to investing domestically.
Where was this risk capital going earlier? Was it just sitting on the balance sheet?
It was sitting on the balance sheet, sitting in the bank balances, in bank accounts, sitting in terms of a whole slew of very poor investment decisions offshore. And so really, for the first time in 30 years, you are seeing domestic corporate entities intentionally increasing capacity in India. And that to me is what's so powerful and so encouraging.
India always is very scarce in terms of capital. Do you think the kind of growth opportunities which are presented to India with all the dislocations happening and the kind of reforms which are happening in India, is that capital good enough?
Absolutely not. I mean, there is no country in the world that is entirely dependent on domestic risk capital to grow on a sustained basis. You absolutely need the ability to attract foreign risk capital that sometimes has an even longer duration than you do. The US had exactly the same challenge when they sold their war bonds. I mean, domestic risk capital out of Japan or out of Southeast Asia funded a lot of the infrastructure investments that took place in the United States in the 50s and the 60s. Domestic risk capital out of the United States funded a lot of the infrastructure development that took place in China in the 1990s and the early 2000s. And while domestic risk capital in India will provide a sustained base for investments, you absolutely need the ability to continue to incentivize foreign risk capital, both fixed income and equity focused, Indian long-dated infrastructure assets in particular, and manufacturing assets as well. And so you need the ability to leverage your domestic base to increase the attractiveness for a foreign investor. And to the extent that regulations now allow you to invest freely across sectors in India, you then have the enabling resolutions in place to allow that foreign risk appetite to find a home in India. And so I believe that if you look at big picture, broad numbers, India's path will probably most closely resemble China, where domestic risk capital provided 30 to 40% of the growth capital required whereas 50 to 60% came from offshore risk capital. And I think India will follow a similar path.
So what you're saying is that India will be at that stage where the foreign domestic risk capital will start putting into India at a scale where it will start growing very, very fast.
I think, again, it's a cascading impact, right, Manish? You have to establish proof of concept. You have to actually demonstrate to the rest of the world that you've created the enabling infrastructure to allow an industrial economy to evolve, that you've created the reforms needed to encourage labor pools to be attractively priced in India, to be able to demonstrate that you've had an appropriately sound environmental and corporate governance framework created in India to establish a long-term investment opportunity in India for foreign investors. And so I think it's a function of proof, the proof needing to be established. Burden of proof is on India to demonstrate that proof of concept of manufacturing in India works, that India has the ability to provide at scale consistency of supply, reliability of supply, and quality of supply for global supply chains. And once that proof of concept is established, I believe it is rational to assume that incremental risk capital will be allocated to India, first by corporate entities offshore, global multinationals with manufacturing subsidiaries in India, and then incrementally by foreign institutional investors, both fixed income and equity focused, and private equity and venture focused. And then finally, retail investors offshore allocating risk capital to India. So I think it's a staged process where it's up to India to establish proof of concept and then to demonstrate that India can consistently absorb that risk capital and provide sustained economic returns on that risk capital being derived.
Where does India stand in this entire spectrum? At what stage? Is it still in the proof of concept stage?
Oh, absolutely. Absolutely. There's no question. I mean, that's my point. This is proof of concept. You know, the reform process in India is 6 or 7 years old. That's all it is. And so you have to demonstrate that you can provide investments at scale, of quality, and reliably in terms of global supply chain requirements.
So if I understand correctly, we are still a couple of years away before that tipping would happen, where initially the corporate risk capital and then followed by other kind of risk capital will follow into India.
I mean, you're at that point today where global multinationals are currently allocating incremental risk capital to India to facilitate the expansion of capacity in India to feed global supply chains. So you're probably 3, 4, 5 years away from being able to attract sustained flows of foreign risk capital into India that are focused purely on financial returns. So this is exactly what we saw happen in China, where it was corporates globally that first allocated risk capital to China with the ascension to WTO, and institutional risk capital took 10 years to follow. And so that's kind of where we are. And so that's the opportunity for India that India has to establish for itself.
Let's switch gears and try to understand, because every investor who goes into India talk about the foreign currency fluctuation, that rupee is highly unreliable in terms of its fluctuation, and it's a capital account controlled economy. How does it impact overall investment scenario for an institutional or for any kind of a corporate investor as well?
Yeah, I would challenge that narrative. I mean, at the end of the day, the currency in India, the rupee, has reflected inflation differentials relative to the US dollar going back the last 30 years. And the Reserve Bank of India has been one of the most consistent central banks globally with their currency framework and their focus on exchange rate competitiveness and the real value of the currency. So yes, to the extent that there is an inflation differential relative to the US dollar and US dollar assets, you should absolutely expect the currency to depreciate. In my view, the currency has depreciated 3 to 4% a year compounded over the course of the last 30 years, reflecting that inflation differential. Nothing changes. And so you build in that 3 to 4% depreciation on an exchange rate weighted basis into your investment strategies, because the growth in the nominal GDP and the ability of domestic Indian companies to leverage that nominal GDP growth to demonstrate sustained top line growth and the operating leverage that translates to sustained earnings growth is what differentiates India versus the rest of the world. And so the nominal returns in Indian rupees more than offsets any potential risk from currency depreciation.
So let's take it a little further. If any investor wants to invest or goes about investing in India, what kind of return expectation in dollar one should have?
You know, it's like you throw a dart at the board, right? Because you're asking me to look into the future and tell you what the stock market's going to deliver and what the rupee is going to deliver. My basic baseline framework is that India's nominal GDP growth will compound over the next 5 years in the 10 to 12% range. I believe corporate India will grow revenues, therefore, in that 12 to 15% range. And you want to be identifying companies that are growing at the expense of weaker competitors, that are taking advantage of global opportunities, and are taking advantage of facilitating infrastructure and reforms being put in place by the domestic economy to grow faster than that nominal GDP environment that I talked about. I believe that if you can identify companies growing top line in the 12 to 15% range compounded over the next 5 years, on the back of operating leverage, you're going to be able to see companies delivering on earnings growth in the 15 to 18% range. I believe that's your baseline expectation in terms of total return expectations over the next 3 to 4 years, where you have the ability of the domestic economy to drive equity returns in that 12 to 15% range compounded.
And let's do a little bit of a comparison here. Why somebody should not only invest into US? And it is not about that US is bad or India is good, but it is more about how do you think the allocation decision should be and whether US will be able to give that kind of a growth which India is going to provide.
The risk reward for every individual investor is going to be different. And my starting place is that if you have your long-term liabilities denominated in US dollars, US dollar assets will still account for the bulk of your asset allocation decisions going forward. However, if you go back and review what happened post the great financial crisis and the quantitative easing that took place facilitated by the Fed in the US over the course of the last 10 or 12 years, you've seen the US deliver on equity performance that's substantially ahead of trend. It has not been because necessarily of the opportunities for earnings growth in the United States. It's been because of a multiple re-rating that we have seen take place thanks to quantitative easing. As we shift gears in the US and as the Fed actually starts to shrink its balance sheet, and rather than quantitative easing, we talk about quantitative tightening, I think it's a reasonable premise to articulate that the US multiple is under threat and the stock price multiple is likely to contract. And that's the opportunity that a market like India provides, where you have a substantial tailwind behind you thanks to sustained nominal GDP growth in the 12 to 15% range. And that's the opportunity I want to focus investors on, being very intentional about making incremental allocations towards non-US dollar assets and India specifically, because as the benefits of quantitative easing are reversed, the opportunities offshore are likely to be significantly more attractive than in the US.
Is India the only place you would recommend for investors to diversify out of US? Or India is among the biggest that would have the benefit of this?
No, absolutely not. I think there are several opportunities, and I talked about it earlier. I think India is a big beneficiary, clearly, because of the demographic dividend that we've all talked about and the significant opportunity that domestic industrial policy provides for long-term employment in India. But Vietnam is a similar beneficiary. Indonesia is a similar beneficiary. Mexico is a similar beneficiary, because I think what we've learned coming out of the last 4 or 5 years, starting with the Trump tariffs, the challenges imposed by COVID and lockdowns of global supply chains, and most recently, the energy dependence in some parts of the manufacturing world globally on oil and gas out of Russia. There's a very compelling narrative to be built around diversifying supply chains globally. Just in time clearly has been the driver of the last 30 years of investment opportunities post China ascending to the WTO. Just in time is in the process of being replaced by just in case. And so there is an absolute imperative on part of global supply chains to make sure that supply chain resilience and supply chain security is now being prioritized, even if it is at the expense of marginal profitability. It is more important to have reliability of supply and the commitment of the suppliers to be able to meet your needs than to worry about eking out a couple of additional percentage points of profitability. And so that's the transition that we're working through globally. And that's the transition I think is going to benefit countries like Vietnam, like Indonesia, like Mexico, and absolutely India over the next decade.
Just in case is a very interesting word you use. So going forward, do you think that India and all these kind of diversification can also pose some kind of a political challenges as well between US and India?
I think it's a reasonable question to ask, given the increased tensions that we've seen between the United States and China over the last 5 years, for sure. But I think where India and the US sit are really at two different ends of the spectrum. The US and India, as democracies, are natural partners. And I think that's an established framework that no one will question. The second derivative, I think, is the access to a very large pool of English-speaking workers. And it was clearly a proof of concept that was established by the Indian IT services sector over the course of the last 25 years. And I think as you extend that proof of concept to manufacturing broadly in India, again, there's a natural bias of US risk capital and US corporate enterprise seeking long-term outsourcing solutions in India. The fact that India will continue to be a counterbalance of size for the US relative to China across Asia, again, is another element that we need to keep coming back and revisiting. So in some ways, I think the US and India, for the foreseeable future, are natural partners, both geopolitically and from economic need from both sides. And so you are going to see both countries actually become closer in their relationships and their ties economically, militarily, and geopolitically. And the best example I can offer up to you is Quad, where the US, Japan, Australia, and India have very intentionally created a framework to counterbalance China's rise across Asia. And that's an element that I think I would be focusing on as opportunity rather than a risk.
We have talked about all opportunities about India. What are the risks?
I think the risks are really threefold. One is geopolitical dynamics, and the impact on the price of oil and energy broadly is something that India cannot get away from. Right? India will remain energy dependent as far as its import profile is concerned. And I think that remains, in my mind, the single biggest risk to evaluate is that geopolitics and the geopolitical risk premium being articulated at high energy prices does constrain India's growth and ability to invest. So that's, in my mind, front and center as I evaluate the risks. The second risk, I think, is clearly political. We've talked a lot about the stability that political consensus and a political majority brings to policymaking and industrial policy in particular. Because remember, industrial policies are 10, 20, 30 years in the making. And that visibility and the stability provided by a stable government is something that is essential and crucial to continuing to incentivize risk capital. So to the extent that you worry about the political stability being challenged, then that's a clear worry to be evaluating and to be measuring. And the third, quite frankly, to me, has got to do with just capital market flows, because the volatility that we've seen, in part driven by leveraged positions being unwound, in part driven by algorithmic or AI-driven trading strategies that tend to be agnostic to actual fundamentals and much more focused on trading patterns that have been observed, creates risk to capital flows and risk capital. And it has implications, obviously, for the rupee and for the long-term returns for investors into India. So those are the three things that I would focus on and say that those are clear risks, and you balance those risks against the opportunity provided by that 12 to 15% nominal GDP growth environment, which is very distinct in a world that's challenged for growth.
Awesome. Thanks a lot for giving this opportunity of let us understand what's there happening in India and what are the opportunities.
You're welcome, Manish. Thanks a lot, and I look forward to staying in touch.
Thank you, Prem.
You've been listening to Investination India. Manish has been a banker, having worked in India for the past 20 years, getting to know investors across the globe, encouraging them to invest in India. Having graduated from IIT Delhi and IIM Calcutta, Manish is the perfect person to learn to invest in India. We hope you've enjoyed the show. Make sure to like, rate, and review. Take care, and we'll see you next time on Investination India.